Meanwhile, I can make my shisha. Grace, how was that YOLO trade with the mitigation block?
What's that?
How was the last trade you took with the YOLO trade on the 300k account? Did you hit TP?
Yeah, I closed it. I closed it at 4K profit. I wasn't sure what time I needed to close for Apex. I couldn't remember. Otherwise, I would have held it because I was expecting them to go down and take out last week's low, and they got, of course, they took price right down to it and then stopped. So there's equal lows there now.
Damn, we did PM version 2.0.
Chadley, how was your disc golf? Frisbee golf, disc golf, same thing? No?
That was good, thank you.
Heck yeah, dude.
Grace, do we finally get to hear your voice? Is it old man grandpa voice?
That's right, old man voice.
Oh, that's not bad.
I started to post. I was looking for a pic of my minivan when I saw you guys posting the cars earlier. I was gonna say, man, you guys don't know what a real car is until you get a minivan.
Shoot. The Apex account you were talking about earlier, Glory, what's the profit target you're supposed to be hitting on that?
20,000.
20K. Yeah.
What? Oh my.
Yeah, it's 20K.
It was a 300K, right?
Yeah, it's a 300K account. I got 8 of them.
Yeah,
Grabbed
20K.
8 of them the other day.
Damn. I didn't even realize Apex did accounts that big.
Yeah. You get that. So at the beginning of the year, they did that 90% off sale. And they did the 90% off and then priced the 200K, 250K, and 300K the same as the 50K, which was like $167. And then 90% off is like $16 a month.
That's right.
So,
is that the highest they go there for account size? 300?
Yeah.
Dang, dude.
35 contract max. 30.
What?
Dude. Yes, sir. It's fun with that. It's really fun. Because you've got trailing, too. You got fucking
trailing. You got trailing. Yeah, I mean, of course, it's designed for you to give you 35 contracts. It's designed for you to blow the account. But if you trade micros, if you trade the micros and just scale in and scale out, it's not too difficult to do.
700 or $700 per point.
Yes.
So my plan is to get at least 5 of them funded and then copy trade them.
Grace, you're basically trading FCOJ at that point. It's like $850 a tick.
Exactly. I'll make sure once they're funded, I'll make sure to record all my trades. So when they deny my payout, I can prove that I didn't do anything wrong. They'll deny it just because of the sheer size of the payout.
Send them a nice screenshot of you and your boxers.
Yeah.
Silent, what'd you say? Your roboting?
Roboting.
This channel.
Laura's not roboting, he's transforming right now.
Is this channel open to everyone?
Bro. Luke, that's a you question.
What's the question?
Is this PM live stream channel? Is it open to everybody?
Yeah. Hold on.
Said with the most confidence ever.
What?
Leave him alone. It's nighttime. Oh wait, that was me.
I'm just making sure it's we're in the
just
right
Zen
channel.
one.
If it's
No, I was just trolling, bro. It's all.
Yeah, I think we should be good
My
to go.
top step back X account. Feel like
and is someone recording this?
Yeah, I am.
Are you you're gonna stream, right, Grace?
Yeah. Actually, let me go ahead and just start sharing real quick.
Okay.
A little checkarooski.
Yeah, if you can also record winners.
they finally sent me the code for my new account voice.
Let's go. You
Good.
so you can use top step X.
Yeah, I finally switched it.
There you go. GG.
And we can see your stream clearly, Grace. You have a good connection.
Yeah, it's great.
Good.
We can stop.
Beautiful.
This is everybody, or you think a few more people are going to join?
They should join, but I think it's Friday. Well, we'll see.
Yeah.
They can join it along the way, so it's fine.
Okay. All right, cool. Well, I'll go ahead and jump in.
Yeah.
Just give you guys a little bit of background about me real quick. I've been studying ICT exclusively for 4 years. I started trading because a friend of mine at work, he bought a bunch of XRP and told me about it. I didn't know anything about trading or crypto, and did some research on XRP and I bought some XRP, and then I got interested in how you could trade crypto, and that's what kind of started me on my trading journey. And I was learning for about a month. I was learning from, the retail concept from the trading channel and Raynard Teo, I think is his name. Those two channels, I was learning how to trade head and shoulders and support and resistance. And I studied for about a month, and then I was going to start paper trading. And my uncle is actually a trader. And when I told him I was about to start paper trading, he was like, "Wait a minute, don't start yet. You need to check out ICT." And I watched the first 2 videos of ICT's Sniper series, and I knew instantly when I watched those first 2 videos, I was like, "This guy knows something that's different." And so I've been studying ICT exclusively since then. That was 4 years ago. And so, I've been studying like a madman, as you can tell. So that's how I kind of got into trading and got into ICT. So that's just a little bit about where I'm coming from. Right before I get started, I just want you guys to know, I'm just sharing my perspective based on what I've learned. So I'm not saying anybody else is wrong or that I'm right. I'm just showing you what I see in the market. So I'm here to learn together with you guys. So please provide any feedback, that you have. And if you see something that you have more insight in, please let me know, because obviously I'm trying to learn so I can quit my job and be a full-time trader. Not full-time yet, but this year, hopefully, this year will be the year I'm full-time. So I'm going to go ahead and get started. Hopefully you guys had a chance to review that outline that I posted. That's what I'm going to be using to go through the teaching today. And then we'll try to leave time for some questions at the end. So I'm going to start on I'm actually going to start on the gold chart, the gold monthly chart. So what I've learned about market maker model theory and just all ICT concepts in general, I really feel like the main reason that most ICT traders fail is because they end up trading ICT like retail. And what I mean by that is you learn order blocks and breaker blocks, and you learn all the PD arrays, and you learn every time. You can see that every time ICT comes out with a new video and he comes out with something new, everybody jumps all over it and starts trying to use it. Well, if you don't understand the narrative of the higher time frame, then it really doesn't matter. You're gonna go on the lower time frames and you're looking for PD arrays, and what you're doing is looking for another pattern. You're looking for an order block or a breaker block or a fair value gap or whatever. And you're looking for that pattern without the context that it's in. This is what I believe is the difference that makes the difference in trading, successfully trading ICT, is that if you understand the higher time frame narrative or the context of the PD array, then you know how to use them and which ones you should use on any given trade. ICT says this all the time in almost all of his videos. You need to understand bias and narrative. The entries are the easy part. The PD arrays give us the entries, but it's the higher time frame context that tells us why we should enter a trade and where we should enter a trade. So if you go back through ICT's videos, I think I posted it on the Discord sometime earlier this week or last week, but just randomly go through 5 or 10 of ICT videos on his YouTube channel. You will notice he always does top-down analysis. He always starts with the weekly or the daily chart. And that's because the most important thing is higher time frame narrative. And so the way that I trade, I break the market down into 3 categories: higher time frame, intermediate time frame, and the lower time frame. The purpose of the higher time frame protocol the purpose of analyzing the higher time frame before you do anything else is so that you can determine the directional bias. And then that's going to give you the context for where you should be looking for liquidity and where you should be looking for market maker model. So I'm just going to use gold as an example. All right, so I'm going to start on the monthly chart. When I open my charts, I have my night routine and then I have my morning routine, and I posted that for you guys. The very first thing I do is go to the monthly chart. I'm going to the highest time frame that I want to use. And the first question I'm asking myself is, are we trending or are we consolidating? The market is either going to be in one of these 2 states. Obviously, ICT taught the 4 market conditions, which is the 4 parts of the market maker model. You have consolidation, expansion, retracement, and reversal. But just to make things simple, I only want to know, are we consolidating like we are here, or are we trending? Because I'm going to trade those markets differently. If we are consolidating on the higher time frame, the very first thing I'm going to do is go down to the intermediate time frame, and I'm just going to trade liquidity. If we're consolidating up here and I can't tell what the bias is, what the directional bias is, there are ways to trade in this, but I'm not going to talk about that. I'm going to mainly focus on a trending environment today. But normally, if I see that we're consolidating like this on the higher time frame, I'll just skip the higher time frame completely, and I'm going to trade intraday liquidity. I'm going to go to the intermediate time frame, find liquidity, and I'm just going to derive my directional bias for the day based on how price trades into those liquidity pools. So that's the first thing I want to know. Are we trending or are we consolidating? If we are trending, let me define what I mean by trending. ICT order flow is the basic building block of everything ICT teaches. You need to be able to establish order flow, higher time frame order flow. And obviously price is fractal, so the principles that we apply to determine order flow on this chart, we can also do on the lower time frames. So the first thing you want to do is determine whether order flow is bullish or bearish. Well, how do you do that? ICT teaches that there are only 2 things you need to establish whether order flow is bullish or bearish. There are 2 questions you need to answer in order to establish that. The 2 questions are down closed candles supporting price? And when he says supporting price, what he means is if you are in a leg of price that appears to be moving up bullishly, if you see down closed candles, are the lows of those down closed candles being traded through? If price is trading through the low of down closed candles, then you're probably not in bullish order flow. Now, let me go a little further in that and saying, and we're going to talk about this a little bit later, but obviously if you're in bullish order flow, down closed candles are order blocks. That's what order blocks are, and we'll go more into detail about that. By definition, an order block is either a single down closed candle like you see here, or a series of consecutive down closed candles. If you have multiple down closed candles that are consecutive, then you will take the range of the high of the highest up close or down closed candle and the low of the lowest down closed candle. Now here in this one, this candle is actually an inside candle, so you would just use this one as the order block. But if this candle had been lower than that one, you would use both of these candles together as the order block. And you want to ask yourself, the lowest low of that series of candles, is it being traded through? Obviously, we can see it's being respected here. The low of this one is being respected. So the first qualification of bullish order flow has been answered. Down close candles are supporting price. The second question you need to ask yourself is, are current candles breaking the highs of previous candles? So in bullish order flow, the highs of previous candles should be taken out. And we can see that the high of this candle is taken out here. The high of this candle is taken out here, so on and so forth. Each previous candle's high is taken out. So if those two conditions are present, down candles are supporting price, they're not being violated, and the previous candle's highs are being taken out, and you know that you have bullish order flow. And of course, everything is reversed for bearish order flow. First thing you want to do on the higher time frame is determine if we are consolidating or trending, and if the order flow is bullish or bearish. We can clearly see that our order flow here on gold is bullish. Once we've established that, the next thing that I do is I want to determine what the power of 3 for this candle should look like. Now I'm using the monthly chart, but just assume this is the daily chart. We're going to go down to that in a minute. But this would be the same if you were just, well, let's just go down to the daily chart. We're on the daily chart now. And on Monday, if you were pulling up the daily chart, and you were using the daily chart, you would ask the same question. Are we in bullish or bearish order flow? We're going to answer 2 questions. Are down candles supporting price? And are the previous highs being traded through? And we can see that that is the case here. So we're in bullish order flow. And so the next thing I want to know is, what should the power of 3 look like for today's trading? Now, in the power of 3, there are 2 conditions you need. And the reason that is important, let me go back to the monthly chart. On the monthly chart, we obviously see we have a big bullish candle, and where price is currently trading, we are not close to a PD array on this chart. The nearest PD array would be this old high right here. But we are a good distance away from that. So if we are not close to a key higher time frame level, and it just kind of looks like we're in no man's land, you would expect a normal power of 3 to happen. And what I mean by the normal power of 3 is that you're going to take the high and the low of the previous candle. You're going to mark out the high and the low. And you know what? Let me just use my dip tool here. You're going to mark out the high and the low of that range. This is the 50% level. Now, there's a statement that ICT made, and I have it in my notes. I can provide you guys the timestamp. But he said, if price opens up above 50% of this candle in bullish order flow, if price opens in this upper quadrant, then like 80% of the time, we're going to take out the previous high. That's going to be our target for the day. But what we would expect is price to open up somewhere in here. And then with the power of 3, we're going to expect price to go down, but stay above the 50% of that candle. And then once it's going to go down, hit a key PD array on the lower time frames, then our target, once it turns bullish, will be the previous day's high. Well, this is the top-down approach that I take when I'm just determining bias on the higher time frame. I want to know, are we trending or consolidating? Are down candles supporting price? Are previous candles highs being traded through? And then what should the power of 3 look like? What would I be expecting to happen? And I'm going to expect us to continue being bullish since we're not close to a higher time frame PD array. If we are trading close to a PD array or a key level, I would expect, I would want to see if we are going to create a retracement like this. Are we going to create a new order block? Because as we're going to see in a minute, one of the qualifying factors of a true high probability order block is that it has to be going down into another key level, another key higher time frame level. Just because you see a down candle doesn't make it an order block. It has to be hitting a key level in order for it to be a true high probability order block. So if we are in no man's land up here and there's no higher time frame level that's close to where price is trading, I'm not expecting an order block to form here. I would expect price to go down just because of the power of 3, but that doesn't mean it's going to create an order block. I'm going to expect it to go down and then go up. If we are near a higher time frame level, we could create a down candle for that day, in which case I would not expect a bullish power of 3. And this is how you can kind of get an idea whether we're going to create an order block or not, because if you're expecting power of 3 to happen, you're going to be looking for bullish moves. But on down close days, on order block days, it's not going to be a bullish move. It's going to be a bearish move. And so that will immediately put you offside. You're going to be trading during the day, and you're going to be offside all day long before you realize this is going to be a down close day. So that's just one of the factors that I use to determine whether I'm expecting a down close day or to continue the bullish trend, is whether or not we are close to a higher time frame PD array. Once I have determined order flow, and once I have assessed what I think Power 3 is going to do, the next thing is to mark out any key levels that are close to price. So if we were down here, if we were on this candle instead of these two candles being there, if it was on this day that we were trading, I see that we're close to an order block. For order blocks, the most sensitive level is going to be the opening price. Obviously, the high is going to be a sensitive point. The mean threshold will be sensitive, and you can mark out the low as well. But the most sensitive point that I have observed is the opening price of an order block. So if we were on this day right here, and I'm expecting to start trading on this day, the first thing I'm going to have marked out is the opening price of this order block. But I would also mark out the high. I would mark out the high and the open, because when you go down to the lower time frames, your trades are going to form at these levels. This is really important, and I've posted that video where this all came to clarity in my mind, that ICT taught. When you mark out these higher time frame levels, I'll just jump down there real quick and show you. Notice how price reacted right at the opening price of that order block. And I'm going to scrunch this up a little more. Look how price reacted right here. And this setup, this return, there was a small fair value gap that was created right on the high of that order block. And the return into that fair value gap could be your entry, and then you would have caught this whole move. ICT specifically said in that video, if you are not marking out these higher time frame key levels, you are missing trades. And that's what really kind of got me started down that path. I just wanted to see what he was talking about. And sure enough, when you mark out those higher time frame levels, you're going to find trades that you just didn't see before. And so that's what I do to determine the higher time frame bias. Are we trending or consolidating? What is current order flow? What should Power of 3 be for the next candle? And then mark out all of the higher time frame PD arrays. Now, as the bonus question, like I mentioned earlier, how do you know where bullish or bearish order flow begins or changes? How do you know where to find that? Well, the simple answer to that, obviously there are other ways to do this, but the foundational answer to where does order flow begin, whether bullish or bearish, where does it start? It starts at an order block. All right. A true high probability order block is going to be found at the smart money reversal of a market maker model. Now, there are 4 qualifications of a true order block, a true high probability order block. These 4 things must be present. And I'm going to show them to you right here just on this monthly chart. The first thing to define a true order block is that it's a single candle or a series of consecutive candles that takes liquidity. So I'm just going to use this right here. Here's liquidity. This is sell side liquidity. And so this is a series of candles. So it can be a single candle or a series of consecutive candles. It's important that they are consecutive. If there was an up close candle in this series of candles, these would not all make up one order block. It would only be the order block or the candles that are consecutive that make up the order block. But here we can see a series of consecutive candles that make up an order block. And so the first qualification is that it's a single candle or series of candles that goes into liquidity. It's got to take out liquidity. Now, everybody may not agree with that, but if you watch those algorithmic theory videos that I posted, you will see why I said that's the case. In the 4th video of the algorithmic video theory, algorithmic order flow videos that ICT taught, he taught this principle that you are looking for an order block to go into liquidity. That's the first qualification. An order block has to take out liquidity. The second qualification is that when it takes out liquidity, it is hitting another key higher time frame level. Now, in this case, I'm already on the monthly chart, and we're going to talk a little bit later about the difference between nested levels and overlapping levels. Let me just briefly mention that nested levels are levels on a lower time frame that are inside of a higher time frame PD array. So if you have an order block, let's say on a 1 hour chart, and that order block is located inside of a 4 hour fair value gap, that's a nested PD array. It's one time frame, a key level on one time frame nested inside of a key level from another time frame. But overlapping levels or overlapping PD arrays are PD arrays that are on the same time frame. Here we have an order block. We have a down candle right here. We have one order block taking liquidity and going into another order block. So that's the second qualification. The first is that it's got to take out liquidity. Secondly, it's got to be hitting another key level. The third qualification is that when an order block is taking out liquidity and going into a higher time frame key level, it must also be occurring when it takes liquidity. The taking of liquidity must occur at an old area of institutional order flow on the same time frame. That's what we're seeing here. It's taking liquidity, and this is sell side liquidity, but this order block represents a place where they were buying before. This was buy side liquidity. They were buying here. Smart money was buying in this down candle, and then the algorithm pushed price up, delivering buy side. Buy side started to be delivered right here. Now we're taking sell side inside of an old area of buy side. And if you don't understand what I'm saying, I don't want to spend too much time on that. Go back and watch those algorithmic theory videos. This will make more sense. So this order block is doing three things. Now, we can't see any higher than the monthly chart, but and I may use another example later on a lower time frame. But this would be going into sell side, hitting a higher time frame key level, and overlapping with an old area of buy side. Those are three qualifications of an order block. And then the fourth qualification is after it has done all three of those things, then there must be a market structure break that creates the fair value gap with the market structure break. Let me just jump down into the lower time frame so you can see the market structure break. So we went into sell side, hit a higher time frame key level, which we can't see, but we would have seen if we could go a higher time frame, and I'll show it later. We did it inside an old area of buy side, and we had a market structure break right here that created a fair value gap. We broke this swing high, and that was a market structure break. Now, there is something important about a market structure break. I see a lot of guys on YouTube saying that a market structure, in order for it to be a true market structure break, price has to close above the swing high. That is not true. I have 4 different timestamps of 4 different videos where ICT specifically says price does not have to close above the swing point in order to be a market structure break. Even if it just wicks above it, if all these other qualifications are present, as soon as we wick above the opening price of that order block, as soon as we wick above that through that opening price, that is a change in the state of delivery. That's the true change in the state of delivery. It's the opening price of the order block, the consecutive candles. When price trades through it, even if it doesn't close through it, that constitutes a change in the state of delivery. Somebody mentioned earlier in the Discord how that I can't remember who it was I was talking to, how that they don't like to trade NQ because NQ's price action is not as clean as ES. This is one of the reasons why. What will happen is NASDAQ will wick through the opening price, and then it will come out and take this swing low. And when that happens, that makes you think that we did not change the state of delivery. But we did change the state of delivery, and NASDAQ is designed to come back and stop you out and then run the other way. I'm sure we've all seen that happen. We thought it was a change in state of delivery, so we get in a trade. Then it comes back and takes out this low, which we expect it should not do. But it does. It'll take out that low, and then it'll run the direction that we had, in our minds in the first place. That's because as soon as you see it trade through that state of delivery, it does shift order flow, but then manipulation takes place again and you'll get a lower low. 9 times out of 10, when you see that happen, if you go look at ES, you'll see ES made a higher low. You'll get an S&T divergence right there. And so that is another confirmation that we really did change the state of delivery, even though NASDAQ came back and stopped you out again. And that'll give you the confidence to get back in the trade with half the risk. So 4 qualifications of an order block. Consecutive series of candles going into liquidity, the opposing liquidity of whatever order flow is. Consecutive candles or a single candle going into liquidity inside of an old area of the opposing type of liquidity and creating a market structure break. When you see those 4 things, you have a high probability order block. And this normally occurs at the smart money reversal. Now, the other place you will find high probability order blocks is at the highs of redistribution in a market maker sell model. You're going to find the same thing that you find in a smart money reversal. You're going to find that same thing at the highs of redistribution or at the lows of reaccumulation in a market maker buy model. We'll talk a little bit more about that later. I'm going to stop right there before I go to the intermediate term time frame protocol and just see if you guys got any questions. I know that's a mouthful. That's a lot that I've said. Anybody need clarification on anything? You want to just type it in the chat? What do I mean by the 4th point? Do you mean the market structure break? Creating a market structure break with a 4th point of FVG with displacement. Okay. Go back to the weekly chart. This is important. Now, right now, what you're seeing, you know what, let me use this right here. Okay. This, let's see, which one is the lowest body candle? This is actually the lowest body candle here. So this would, if I were looking at this chart, I would be using this as the order block. Now, if you look on the monthly chart, this whole set is order block, an order block. But you can refine this order block by going down to the next lower time frame and look for, remember the order block has to be consecutive. So on the monthly chart, this is one order block. When you go to the weekly chart, you can refine this large range by looking for the next lowest set of candles. Obviously, they're broken up here. This order block on the monthly chart is broken up by these up close candles. We can ignore all of this price action when we're refining an order block and go down to the lowest, we want the lowest body candle, which would be this candle right here. And so now this would be the order block that you could use if you were refining this order block to reduce your risk. Okay. We are inside of liquidity over here. So we're underneath that. And once this order block is created, which is the last lowest down close candle, price breaks above it, the opening price right there. Now, when price breaks above this opening price, we are now waiting to see a fair value gap created. There was no fair value gap created in here. There's a volume imbalance there, but there's no fair value gap created. But then on this candle, we get a fair value gap. And this fair value gap took out this swing point right here. This would be a breaker. This is the breaker because this is the last series of up close candles before the down move. And we start going down. This is the order block because it's the lowest down close candle. And then we break above that. This whole swing started up here. Swing down. And when we break above that with this fair value gap right here, let me just mark that gap out so you can see it more clearly. What are we on? This candle to this candle is the fair value gap. So the fair value gap happened above the order block. So we went into liquidity, and then we created a market structure break with a fair value gap. ICT teaches when price comes back into this fair value gap, that's your trade. Now, remember when I talked about overlapping levels earlier, there's a fair value gap, and if you're a fair value gap trader, this is your trade right here. As soon as price enters below the low of this candle, you're in the trade. But you may not be a fair value gap trader. This may not be your pattern. You may be a breaker block trader. Well, here's your breaker. What is price doing right here? Coming back into the breaker. You could have taken that trade based off of the breaker. So it just these are overlapping levels. This is the key level, breaker, and the fair value gap is the key level. So either one of those you could have used as your entry. But this is what I mean when I say that there's a fair value gap that breaks the market structure. Does that make sense? Okay, cool. Anybody else got any questions before I go to the intermediate time frame? Okay, cool. I'm gonna clear this out. All right. So when I say higher time frame, I use the monthly, weekly, and daily. Now, before you know what, there's one other thing I want to mention before I move on to the intermediate term time frame. I created a model called the sequential time frames model, and I posted that in the MMXM secret. That model came from, and I think I posted the videos that you needed to watch with that. ICT was teaching about order flow, and it's easiest to do this if you just use 3 consecutive time frames. It doesn't matter which 3: monthly, weekly, daily, 4 hour, 1 hour. It doesn't matter. But the first thing you're going to do is determine what is order flow, bullish or bearish. We already did that. Okay. In bullish order flow, down candles should support price. So the higher time frame always takes precedence, right? So if we're bullish on the higher time frame, we expect that bullishness to continue until we hit a key level. So if we're bullish on the highest time frame, we expect bullish prices. So if all 3 time frames are in agreement, if the monthly is bullish, the weekly is bullish, and the daily is bullish, if all 3 are in agreement, then the next lower time frame, anytime you see a down candle or series of candles, you can enter the trade on that single candle, because the higher time frame, they're all in alignment and they're going to carry order flow. So if there is a down candle, what is happening when a down candle is created in bullish order flow? It is opposing the higher time frame. Who's going to win the tug of war? The lower time frame or the higher time frame? Obviously the higher time frames. So if you have 3 higher time frames that are in sync with each other and you get an opposing order flow on a lower time frame, as soon as the lower time frame order flow comes into a key area of the higher time frame, it's going to snap back into line with the rest of it. Let's say you didn't even use the fourth. Let's just say we just used these 3. Okay. The monthly is bullish. As soon as I see a down candle on the next lower time frame, I'll just use these 2. I expect to continue higher. As soon as I see a down candle on this time frame, I am waiting. What I am waiting for is price to break above that high. So once this is created, the next day I'm waiting. And if we break above that high, as soon as we retest that high, I'm in the trade, and my stop loss would be below here. Now, obviously, you wouldn't want to do that on a daily chart, because that means you wouldn't be trading at all on this day. But let's say you're looking at a 5-minute chart. This principle is exactly the same. If let's say this is the higher time frame was the 15-minute chart. If this is a 15-minute candle and you're trading the 5-minute, as soon as you see this on the 5-minute, you are now waiting to wait for price. You're waiting to see price break above this high. And as soon as price breaks above that high, there is going to be a retest. There's a guy, when I first, probably about 2 years ago, his name is Braveheart. His YouTube channel is Braveheart Trading. And I got into his mentorship. He's the only one, I think he's the only one I ever paid for. Now, I think I paid for Ali Khan's too, but I wasn't in Ali Khan's very long. But Braveheart's, his style of teaching ICT really opened my eyes to this. You have an order block, you're going to have 2 types of retest. You're going to have an instant retest and what he calls a rounded retest. An instant retest is as soon as we break above that high, within the next few, depending on what time frame you're on, very shortly after you break above that high, price is going to instantly retest that high. And that's your entry. Wait for price to break above it and tap it again. That's an instant retest. A rounded retest is when you see price move away from it and then come back to it. Price is going to come back to it, and how's it going to do that? It's going to create a propulsion block. It's going to be another order block that hits this key level. So you can either enter on the instant retest or on the rounded retest. But when a down candle is opposing the higher time frame order flow. That's why down candles work. And so you can wait for price to break above it, and then as soon as it comes back and touches it, you enter the trade here, put your stop loss below here. Why are we putting a stop loss below there? Because in bullish order flow, down candles should not be violated. If we get violated when we put a stop loss there, one of two things is happening. Either price is reversing, or, and it could be short-term or long-term reversal, but either price is reversing or price is consolidating. Because if you get stopped out and price is consolidating, it's going to go above this high, back below the low, then it'll go back above the high again, and then it'll chop around in there. You don't want to get stuck in that. So if you get stopped out, that's telling you something, trying to tell you that price is either going to consolidate or price is reversing and you're on the wrong side. You enter at the high of an order block, put your stop loss at the low of an order block, because what's happening is price is now getting back in sync with the higher time frame order flow. So the opportunities that we have to trade, we want to be entering when a lower time frame is opposed to the higher time frame. Because once that opposition gets back in sync with the higher time frame, and it's going to be an explosive move, which is what we see here. Same thing over here. We had down candles opposing the higher time frame order flow. It hit the key level. And on this candle right here, we broke above the order block. Now, remember I said consecutive candles make up an order block. But that last down close candle is also an order block by itself. So if you want to reduce risk, you can use just that down candle. If you want to play it safe, you need to wait for the high of this candle to be broken. And you can see over here, we broke through the high there. We get an instant retest on this candle, and then it's off to the races. So you would wait for price to break above this high. It broke above it there. When it comes back down into it, you're in the trade here, but your stop loss would have to be down here. That's a lot of risk. But if this is a 5-minute chart or a 1-minute chart, that's not that much risk. If you're on a 15-minute chart or a 1-hour chart, that's a lot of risk. So you can refine this order block by using just the last candle. Or you could go down to a lower time frame. Let me just mark this out. Another way you can reduce risk is go there, find where it's broken up. This was an up close candle, so we can ignore everything up here. These consecutive candles are the order block that we're looking for, and you would use this as the breaker block. That's how you refine an order block. So it's at order blocks, at high probability order blocks, that order flow shifts. We were bullish here, order flow shifted bearish, and it got back in sync with the higher time frame. Here, it shifted bullish. Notice when we shifted bearish, we have an order block right here. These consecutive candles are an order block. This is very important when we talk about dealing ranges, which I'll talk about in a minute. The high of a dealing range, of a true dealing range, and the low of a dealing range will always have order blocks. The extreme high of a dealing range and the extreme low of a dealing range are always going to have order blocks to be the end caps. So we'll talk about that in a minute. All right, so hopefully I've made that clear how to determine bias on the higher time frame. Are we consolidating? Are we trending? What is the current order flow? What should the power of 3 be? And then make sure you mark out all the higher time frame key levels before you go to the intermediate term. Okay, now let's talk about the intermediate term time frame, the intermediate term protocol. I use, for my intermediate term time frames, I use the 1 hour, the 30-minute, and the 15-minute. Those are time frames that I use for intermediate term. And let me just go and I wanted to use gold as an example. Here's what I'm going to do. I'm going to mark out higher time frame. So this is the daily chart. Let's see. This is the lowest down close candle. So this would be the order block because I want to show you what happens when you mark out these levels. I'm just going to mark out the high and the open. Let's see. We want the daily. This is the daily open. And I'm going to mark out the high and the open. Really high and low. Okay. What are higher time frame key levels? What does that mean? The higher time frame key levels means any PD array on the higher time frame. And I think, if I'm not mistaken, I put this in the. I'm pretty sure I put this in the MMXM secrets channel. But the higher time frame key levels are any order block that you find on the higher time frame. I mean, not higher order block, any PD array. So for inefficiencies, that means fair value gaps, volume imbalances, new week opening gap, new day opening gap, any type of inefficiency in price. The sensitive levels are the high, the low, and then the quadrant levels. The 25% level, the 50% level, which is the consequent encroachment, and the 75% level. Key levels of an inefficiency are the high, the low, and the quadrant levels. The key levels of any order blocks, that means a regular high probability order block, a breaker block, a mitigation block, any type of block, the key levels are going to be the high, the open, the low, the close, and the mean threshold. Those are key levels. So notice what I'm doing here, since we're using an order block, I'm marking out the high and the open. You could also mark out the mean threshold, close, and the low. High, open, low, and close, and the mean threshold of order blocks. And then if it's, I'll just go ahead and mark this one out. This is a volume imbalance. What is this? The daily chart. So let's go daily VI. Actually, instead of doing that, I'm going to pull I'll pull the fib on it. You can see the quadrant level. I have my quadrant levels color coded because that makes it very easy for me to see what the levels are. So this is the low. This is the 25% level, the 50%, which will be consequent encroachment, 75% level, and then the high of that volume imbalance. So now we're going to go down to the intermediate time frame. If they overlap or are nested, do you mark all three or just the most refined? That really just depends. It depends on what I'm looking for. I think I may answer that question a little bit later, so let me come back to that one. But what I want to show you is what's happening around these levels. So again, for the intermediate term time frames, I use the 1 hour, 30 minute, and 15 minute. The only thing I am looking for, well, the primary thing I'm looking for on the intermediate term time frames is liquidity. That's what I'm looking for. And I'm looking for liquidity that is located near these key levels. So let me go back up to the daily chart. I want you to keep these levels in mind. This is that order block. Notice that this is a retracement, okay? The reason I'm pointing that out is because in bullish order flow, when you have a retracement, this is going to be a market maker buy model. Every retracement in bullish order flow is going to be a market maker buy model on the lower time frames. What is this retracement doing? Why is it retracing here? It's going into this order block. Market maker models, the purpose of their existence is to go into a key level to accumulate more orders and then resume the higher time frame narrative. That's what's happening here, and we're going to see that in a little bit. But I'm marking out the high. This is what I want you to pay attention to. I only marked this out just to show you the inefficiency on a lower time frame. But this is what I want to draw your attention to, because we're going to look for, on this day, we're going to look for liquidity that is located around these levels. Okay. When I'm looking at the intermediate term time frames, what I am doing once I mark those levels out, I'm looking for liquidity that is located there. I want to see if I can see liquidity. Let me go to the 15-minute chart. Now, what I don't currently have turned on, I'm going to turn it on. This is the indicator I use. Oh, you know what? I don't think I have it on this. Yeah, there it is. Okay, that is the right one. Change these settings real quick. Anyway, well, I won't worry about it. I'll do it later. This indicator that I use is the which one is this one? This is the ICT kill zones and pivots by TFO. You can use whatever indicator you want, but I use this indicator because I can color code the session highs and lows. Key liquidity pools that you are looking for are previous session highs and lows. Now, ICT has a video, I think it's month 8, if I'm not mistaken, in the core content, where he tells you the key higher time frame levels to look for liquidity pools. And he says it's previous day highs and lows, previous week highs and lows, previous month highs and lows, and then previous session highs and is going to also be a session high and low, or the previous week highs and lows and the previous month. All of those key levels are also going to be a previous session high and low. So I only focus on the session highs and lows because that's going to allow me to get the previous day, previous week, and previous month highs and lows as well. But these are the key liquidity pools that you are looking for. That's where you're going to find your major intraday reversal is at the session highs and lows. And from what I understand, a lot of you guys use the sweep strategy, and I think that's what the sweep strategy is using is the previous session highs and lows, and you're looking for the 2022 model to occur at those levels. That's the same thing I'm doing. But I'm using the higher time frame narrative. So if I'm expecting bullish prices, I want to see sell side liquidity that is located near these levels. That's what I'm looking for. I'm looking for sell side liquidity located near these levels. Okay. So on this particular day, we were below these levels. We were below the opening price of that order block and the daily high, or that order block high. So I'm expecting us to run up towards that high on this day. All right. So what I'm looking for is liquidity, sell side liquidity below this level that we can run through and then reverse and go that direction. Well, if I'm trading in the New York AM session, this is the open of the New York AM session. So before the New York open, I would have been looking at these candles right here. None of this price action would have taken place. I'm looking at the price action up here, and it looks like we would have seen that we had actually already ran through those levels. But I would be expecting a retracement. Remember that instant retest I talked about? I would be expecting, since we already ran through them before the market opened, I would be expecting an instant retest into those levels. And I'm looking for sell side liquidity below that price. Well, the sell side is right here in the London session. So this is how I would have marked it out. There's sell side liquidity. And then I would have marked out the buy side liquidity. Let me just take this off for a second. The buy side, if I was looking at price right here before the market opened, buy side liquidity is up here. These are the relative equal highs. So what I'm doing is framing out my entry and my target. Oh, that should be buy side. I would want to be entering somewhere below here, and I would want to be exiting somewhere above here. So when the market opened in the New York session, it ran down to grab that sell side liquidity, and then we should get a market structure shift here on a lower time frame, and that's where I would enter, and we'll look at that in a minute. And then I would be targeting the buy side liquidity that I mapped out. So this is what you're doing on the intermediate term time frame. We've already established on the higher time frame order flow is bullish. So I'm looking for a reason to get long. And ICT teaches that if you want to go long, what you want to see happen is sell side liquidity to be taken. And that's the nearest sell side. If we were looking right here, the nearest sell side would be down here. And of course, you can see that when the New York AM session for me is green. I color code that so I can see it easily. So Asia is always blue, which you can see up here. Asia is blue. London session high and low. This is the kill zone. London session kill zone is yellow. And then New York AM session is green. New York lunch is red. And New York PM session is purple. That just gives me a quick glance so I know what liquidity I'm looking at. And so that's how I would have, if I woke up in the morning and analyzed this chart, not seeing any of this price action here, we would have been on this candle, either this candle or this candle, depending on which time I woke up. And this is how I would analyze it. I'm bullish. I want to find the nearest sell side and the nearest buy side. And I'm expecting to see sell side ran first. Now, sometimes the London session, as you can see here, I would normally, here's a little caveat. If Asia and London consolidated together, if London did not take out Asia's, if we're bullish, and London did not take out Asian's low or Asia's sell side liquidity, if London did not do that, then I would expect the New York AM session to do that. Matter of fact, let me show you that. We actually had this yesterday. Yesterday on NASDAQ, Asia and London consolidated. London did not take out Asia's high. So in the morning, this was my sell side liquidity, and I posted this. You guys saw this in real time. I posted all my analysis as this was happening. This is what I had marked out as buy side. This is what I had marked out as sell side. Since we were bearish, I was bearish on the daily time frame. I expected to see buy side ran first in the New York AM, which is exactly what happened. And then we got the reversal, and I targeted this sell side. Now, you'll see here that we ran sell side first. That's exactly what you want to see. You want to see a fake move first, and then that gets people trapped in the right direction. They go short, and then they jam it right back in their face, take all their stops out because they put their stops up here, and then actually eventually run in the correct direction. And there's a video where ICT talks about this, where you want to see this happen first, and then run the other direction to take out stops, and then the true move for the day begins. So, just to be clear, after we have determined higher time frame bias, on the intermediate term time frames, the only thing we are looking for is the nearest liquidity, and it needs to be in line with our higher time frame narrative. So we're looking for liquidity that is related to these key levels that we marked out on the higher time frame. Let's talk about dealing ranges. This is very important. I just discovered this about a week ago after I discovered the mitigation blocks, and it became very clear to me. In a market maker buy model, let me go over here so I can draw this out for you. All right. In a market maker buy model, this is going to be a sell model. We have original consolidation. Price runs up, comes back and touches the consolidation. Runs up again. Another area of accumulation. Make one more just for good measure. We'll have the smart money reversal. We're going to break down. Measure of distribution. Break down. Another measure of distribution. Break down. Distribution. Model completion. Okay. Okay, let me illustrate this point. ICT defines a dealing range. And again, I got the timestamps for the videos. I can provide this information to you guys. I always try to provide the timestamp so that you know that when I'm saying something, you know where I'm getting that from. It's not something I just made up, but you can go see for yourself if I misinterpreted what he said. That's why I like to provide the timestamp. ICT teaches that a dealing range is a high that has taken out buy-side liquidity and a low that has taken out sell-side liquidity. The question is, the true question would be, why is that? Okay, the true question would be, where do dealing ranges form? Is it just any time that buy side and sell side is taken out? Here's a little nugget that I just realized about 2 weeks ago. A true dealing range, the ones that we are using to measure order flow, so that we base our PD arrays based on a dealing range, whether it's in premium or discount of a dealing range. But what specific dealing ranges are you using? The key dealing ranges, just like there are key order blocks, the key dealing ranges will be the smart money reversal leg right here. Let me just mark this out. This high and this low is going to be your first key dealing range. Why? Because it's the first it's the first leg that takes out a high, takes out buy side liquidity, and takes out sell side liquidity. Wrong one. Let's delete that. This is how you define a dealing range. This is sell side. This is buy side. This is going to be your first dealing range. Okay? Because it has taken buy side and sell side. Why is that important? Once that you have that dealing range, this is where you're expecting price to go above 50%. Retracement into this leg should go above to the 50% level or above it before you start going short. That is a key dealing range. That's your first key dealing range, the smart money reversal. The second key dealing range is going to be the high. Now, let me back up. When this dealing range is created and we retrace inside that dealing range, this leg of price right here is your first area of accumulation. Sometimes ICT calls this the low risk sell. There are some other qualifications that make this a low risk sell, which I'm not going to get into just for the sake of time. But this leg of price is your low risk sell. or your first area of accumulation. The high of that first leg is going to be your new dealing range, because what's going to happen is right in here, there's going to be sell side engineered again. And this is how you can identify a fake out. When price begins to run up in this leg, if it does not reach 50%, if it runs up and starts to drop again, don't go short there. You're going to get stopped out, because they are engineering liquidity so that the next leg can run above that up to the 50% level. So this is the start of your new dealing range, because you're going to have buy side in here, and then it's going to take out the sell side right here. So this high, and then this low become your new dealing range. And then you're going to get a retracement in there. This is the area where you're going to find a mitigation block, which we'll talk about in a second. That's where it's retracing to. It's retracing to that mitigation block, but it's going to be above 50% of this range. When that comes up, this is going to be your new dealing range. These are where you find the true dealing ranges. It's at the highs of areas of accumulation or distribution on a market maker sell model, and at the lows of areas of accumulation. Those are your true dealing ranges. That's what you're looking for. And I will point this out when we get onto the lower time frames. So the intermediate term, we've already established the higher time frame protocol, and the intermediate term, we are looking for key liquidity pools, and specifically the previous session highs and lows that are located near higher time frame PD arrays. That is what qualifies them. One last thing I want to point out. Everybody talks about internal range and external range liquidity. Internal range liquidity is right here. These lows, when you have the market maker model, internal range liquidity are the previous areas of accumulation. Let's still do that. When people talk about internal range liquidity, these are the internal range liquidity pools. So we are still inside the range of this high, low and high. The buy side of the curve, as long as price is trading inside of this range, these are the internal range liquidity pool. The external range liquidity pool is the low of the original consolidation. That's what we mean by internal range and external range liquidity. Each one of these previous areas of accumulation that creates a low, that is going to be your liquidity pools on this side of the curve. And you're looking to see if these will be the lows of a previous session. Some previous session is going to create these lows. And same with this one. So this is internal range liquidity. This is external range liquidity. All right. So any questions about that before I move on to the good juicy stuff, getting into the actual market maker models and the mitigation blocks? Gotcha. Yeah, I do have those saved over here. I didn't realize I have to go through the settings, so thanks. Nice little tip. Okay. Anybody got any questions about the intermediate term time frame and how that coincides with the higher time frame before I go to the last section? Yeah, the first leg is the most important because that sets the stage for now. This is why you want to trade this side of the market maker model. You can trade this side, and that's very advanced. If you're going to trade this side of a model, you have to know what price is reaching for, the higher time frame PD array. And this is where what the side of the model ICT teaches that you can use the projection fib. You can actually forecast where these accumulation areas are going to occur before they actually happen. As long as you see the original consolidation and you know what the PD array is that we're reaching for, you can actually forecast before price even trades here where these areas are going to occur. Once we get to the smart money reversal, this leg right here, once we get to that, you already have all of this structure over here to guide you in your trades. And that's why mitigation blocks are so important, which we're going to talk about in a minute. Once this side of the curve is completed, this is easy trading over here. And we're going to talk about different types of market maker models. Let me just briefly mention that, and then we'll discuss this in detail. This whole thing right here is a fractal, right? Oh, come on. Okay, there we go. Let me take some of these lines off of here. I don't know why it just does not want to move over. Here we go. This whole thing is a fractal, right? So this could be any time frame. So if we are on a lower time frame, let's say like a 5-minute or 15-minute chart, we're expecting price to reach up into a higher time frame PD array. This whole model, this market maker model, we are trading using this for context. But each one of these retracement into the dealing range is a market maker model in itself. You're going to have an original consolidation here, run up, just like this leg. So this leg right here is this leg of the model. Then you're going to get a smart money reversal on a lower time frame right here, just like this. And then we're going to come down and complete that model, just like this. This right here is another market maker sell model inside of the larger model. That's why I said on the higher time frame, looking at a price leg on the higher time frame. Just one price leg. Let's say we're just looking at this. Let's go back to the weekly chart. No, it was the daily chart. This retracement, this is just a bullish price leg. Every retracement in the bullish price leg is going to be a market maker model on a lower time frame. This is the daily chart. Okay. Just do the FEG. I just want to highlight this range. Go down to a 15-minute chart. 30-minute might be a little bit clearer. That yellow looks kind of bright. This is a market maker buy model. See that? Got equal highs up here. That's the original consolidation. We drop away from it, come back and touch the original consolidation. This is the first area of accumulation. You may call this distribution because we're on the sell side of the curve, but what they are doing is accumulating short. They're selling short. They're accumulating short orders, and then they drop it again. So this is original consolidation, first area of accumulation, we drop. Second area of accumulation, we drop. Smart money reversal, this is a failure swing. Smart money reversal, first area of distribution. This is still in there, so this would be a second area of a distribution. Why is this the second area of distribution? This is the silver bullet, because this high did not go above that. It created another set of equal highs and then dropped away. This is the silver bullet, and it was the fastest leg that completed the model. So this whole market maker buy model is simply a retracement in this bullish leg of price action. If we go into this, it will be the same thing. I won't do it for the sake of time. But every time you see a bullish leg of price action, if we get a retracement, it's going to be a market maker buy model on a lower time frame. Back to what I was showing, each one of these is a market maker model in itself, and they behave differently. Each one of these behaves differently, and I'm kind of already talking about the lower time frame, but I want you to understand. ICT said something about breakaway gaps. Breakaway gaps form. That's ugly. Let me move this. Breakaway gaps form at these the areas of distribution. This is where you're going to find a breakaway gap. After this smart money reversal, you're going to find a breakaway gap here. After this smart money reversal, you'll find a breakaway gap here. And of course, this is the silver bullet. It's going to be the fastest price leg. So once we get up here, price is in a hurry to get down there. So what are you going to find right here? Breakaway gaps. These are the areas you're looking for breakaway gaps in. You're not looking for breakaway gaps down here. You're looking for breakaway gaps up here, because once it has hit its target, where these legs are opposing this order flow. The higher time frame is flowing bearishly. On the lower time frame, these legs, these retracements are opposing that. They're fighting against order flow. So once they hit the place that they wanted to, they're going to snap back into the order flow of the higher time frame. That's why these legs drop so fast. And then this will be the final one that drops the fastest and the farthest, because it wants to complete this model. You have to look at the fractal. We're in a higher time frame market maker model, but each one of these is also a market maker model. Just like over here, each one of these retracements is a market maker buy model. Order flow is bullish. We drop down bearish. We are opposing order flow. But once we get to a key level, we're going to snap back in line with the higher time frame. That is going to be a market maker buy model on a lower time frame. Okay. So yes, the first leg is most important because it takes buy side and sell side liquidity. That's right. That's the first dealing range, and that is that's the change in the state of delivery for this order flow. The change in the state of delivery takes place right here. This is where you get a breaker. The breaker block right there, the change in the state of delivery happens right on this leg. And then when we retrace, we are simultaneously hitting a breaker, a fair value gap that will be in here, and a premium of this range. So you have 3 overlapping levels, and then price will snap back in line with higher time frame order flow. But you're looking for liquidity already around an area of higher time frame. I'll come back to this question just because I want to finish up. I don't want to keep you guys too long. I want to get to the last, and then I'll come back to this at the end. Okay. So we talked about nested and we talked about higher time frame and intermediate time frame. The whole purpose of the intermediate time frame is to locate key liquidity pools, which are previous session highs and lows that are located around the higher time frame key level. All right, now let's talk about the market maker model. Like I said, I've already been kind of talking about that. We expect market maker models to originate at key levels, and the smart money reversal will occur at key levels. That's what a market maker model is for. It provides the narrative. On the higher time frame, we determine bias. What direction is price moving? On the intermediate time frame, we determine the liquidity pool. But the lower time frame is where we're looking for market maker models that will reach for the liquidity pool. Now listen, we are in bullish order flow here. Now we're on the 15-minute chart. We're not on the higher time frame chart, we're on the 15-minute chart. We've marked out our key liquidity pools. Now we're going to go to the lower time frame because this retracement is going to be a market maker model. Same as it was on the higher time frame. But what is this retracement doing? It is going down to grab liquidity. That's why we need to mark out the liquidity areas, because this is going down the market maker model. That's its purpose. It's telling us how we are going to get to the liquidity. That's what narrative is. Narrative is how do we get there? All right. So this is our target or reversal. So we're looking for a smart money reversal to occur here. But to get down there, we need a market maker model. So here we have the original consolidation. And then we drop below the original consolidation. We come right back up into it. When we go up, let me make this clear. I don't think I said this and made this very clear. Anytime we are in bearish order flow, if you see an up candle in bearish order flow, that up candle represents accumulation. That's what there should not be in a perfect world. When we are bearish, there should be no up candles. It should just go straight to the target, but that doesn't happen. So anytime you see up close candles or a series of consecutive up close candles, that is the area of accumulation. All right. So we got the original consolidation. We got the first area of accumulation. You see another up close candle here. That's the second area of accumulation. And then you could mark this candle as the third area of accumulation, but I probably wouldn't. If we go down to a 1-minute chart, you can refine that order block, and you'll see this is the order block, the smart money reversal. But I probably wouldn't go that far. I'd probably just do it on the 5-minute time frame. But down here is your smart money reversal, which takes place inside of the old liquidity. And then we get distribution, another distribution, and then the model completion right here. But this whole model, its whole purpose was to go down and grab liquidity before we snap back into sync with the higher time frame order flow. So hopefully that makes sense to you guys. All right. I'm just hurrying a little bit because of time. I could talk about this stuff all day, but I know I've been going for a while. I talked about breakaway gaps. Breakaway gaps are going to form when you're looking at a market maker model. The breakaway gaps are going to form when after the smart money reversal occurs, because price has snapped back into the higher time frame order flow, and now it's in a hurry to move away from this premium level. Price does not want to be in a premium when we are bearish. Obviously, we understand the narrative. The algorithm is offering smart money a chance to accumulate shorts, and once the algorithm has given them enough time, it wants to quickly move to a place where they can unload those shorts. And so that's why you get breakaway gaps in these areas. Okay. Talked a little bit about the nested versus overlapping. And I want to let me illustrate that. I think I can't remember if I illustrated that or not. You know what? Let me use I already marked out the high and low of the order block. That's a key. Those are key levels, high and low of the order block. When you go down to the lower time frames, you're going to see order blocks form at those levels. So an order block by itself is a key level. It's a PD array. But notice this is forming at a higher time frame key level. This is what I call nesting. This is a nested PD array because it's a PD array on a lower time frame, but it's at the level of a higher time frame PD array. Notice this fair value gap right here. Where did that fair value gap happen at? It happened, that body is laid directly over the top of that opening price of the order block. When we went to retrace the high of that candle, what did it touch? It touched the high of the daily order block. This is the opening price. So these PD arrays, this is a sensitive PD array. How do I know this is going to be sensitive? Why wasn't this fair value gap sensitive? The body of this candle was not laid over this key level. But this fair value gap was sensitive because the body was laid over that key level. So when we retraced into it, we sharply rejected. What made this one sensitive and not this one? The fact that it was forming at a higher time frame key level. This order block was laid over this key level. So when we broke above it, we came back down and did an instant retest. That order block was sensitive. It pushed price up. Why was this one sensitive? Because it happened at these key levels. So this is what I mean by nested PD arrays. It's on a PD array on a lower time frame that is occurring at a key level of a higher time frame. Overlapping levels means that I have a PD array on the same time frame that if I look further to the left, it's overlapping with another PD array. This is a PD array. It's an order block, but it's overlapping this fair value gap. They're occurring in the same area. These are overlapping levels. This consolidation is actually a balanced price range. That is a PD array in itself. It's a balanced price range because price is balanced in here back and forth. This order block is also a PD array. So it's overlapping this level. When you have overlapping PD arrays, they're going to be sensitive. So you can look for nested PD arrays and overlapping PD arrays. We have both occurring here. These two are overlapping and they are nested. That's a strong algorithmic signature. So this is why it's important to mark out the higher time frame PD arrays. And let me finally get to the one last thing that we all been waiting for, and that is mitigation blocks. All right. You guys have already been using them, so you're starting to identify them. And obviously, I've been transparent with you guys. I just discovered those about 3 weeks ago. Discovered the importance of them, the significance of them. All right, let's go back to this model over here and explain why these are working. All right. There are 4 types of mitigation blocks. There's probably a lot more than that, actually. The more I study, there's probably more than them. But the ones that I'm using, that you honestly don't need anything else. There are 4 types of mitigation blocks, and they're going to occur at specific areas. In every one of these retracements, when price was moving up, right at the top of that, it's going to leave an up-close candle. These are going to be up-close candles. The last up-close candle before we retrace That is a mitigation block. You can call it a breaker block. You can call it a mitigation block. You can call that block whatever you want. You can call it just an order block. But what is happening there is later on, price is going to be mitigated there. So the highest up close candle when we're on a bullish side of a market maker model, the highest up close candle at each one of these points is a mitigation block. And the lowest down close candle as we're going down, the lowest down close candle at each one of these points is a mitigation block. The highest up close, the lowest down close. Same thing on this side of the curve. Anytime we have a swing point, when price was moving in one direction and it swings the other way, the last candle before it swings, that's going to be a mitigation block. So the last down close candle here is going to be a mitigation block. And the highest up close candle here is going to be a mitigation block. Now, the way you use them is going to be different, but each one of those blocks are mitigation blocks. So study the way that price behaves at those levels, and you'll notice that they're sensitive. And that's because of what's going on behind the scenes. The algorithm is allowing smart money traders to mitigate orders that they have underwater. But I want to show you this in action. You guys have been seeing it. But I want to show you. Let's use gold for an example. On the 15-minute chart. Now, this looks like a market maker sell model, and it is. It is a market maker sell model that did not complete. And the reason why is because we are in bullish order flow in the higher time frame. And I got tripped up trading gold earlier because I saw this. And I'm like, oh, man, I saw this leg. And I'm like, yep, we did not complete that model. So this retracement should be the second leg of distribution and the silver bullet, and it should come down. Well, the reason that didn't happen is because I wasn't paying attention to the higher time frame. We are bullish on the higher time frame. When we are bullish, market maker sell models should not complete. Only market maker buy models should complete. The only time a market maker model sell or market maker sell model should complete when we are bullish is if we are running stops. It will be a stop run, and then it's going to snap back into place. But that's going to occur in the discount range of the higher time frame. But I'll leave that for you to study. We're going to look at this as a market maker sell model that didn't complete. We were bullish here, and then up here we get a smart money reversal. Now you may be thinking this is not a turtle soup, this is not a smart money reversal. Well, the turtle soup occurs here. But also remember, it doesn't have to be a turtle soup to be a smart money reversal, because one of them is going to give, you're going to get an S&T divergence. If you're looking at the indices, you're going to get an S&T divergence here. So that means one of them is going to make a higher high, the other one's going to make a lower high. But this is the smart money reversal. And so when we get this leg right here, we get this leg, the smart money reversal. So we get a high, a low, this candle, and then a higher high. All right. What you would be expecting is for this leg to break through the breaker. Now, this is something very important that I just realized maybe about a week or so ago as I was studying all of this. If we create a turtle soup here and we start to come down, we should break through this breaker, right? If the first leg, as it's coming down, if this does not break through the breaker before it starts to swing up, if this does not take out the low of the breaker and it starts to swing up and it fails to take out this high, this is a failure swing. Even if it makes equal highs like we did here, it's a failure swing because it failed to take out the high. When you see this pattern before we take out the breaker, this mitigation block right here is going to be extremely sensitive. Forget the breaker and focus on this. And you can see once we finally we did break through the breaker. But when we reaccumulated, the high of this candle, where did it go to? This mitigation block. And once it hit it, there's a turtle soup here. Smart money reversal that is occurring. Let me make this a little wider so make sure you guys can see it. Smart money reversal that is overlapping with the mitigation block. Look at the reaction. So this is something to look for. You're going to see this happen a lot. I've been noticing it a lot. Price comes down towards the breaker, but starts to go up before it takes out the breaker. As long as it doesn't take out this high, when it finally breaks below it, wait for it to retrace back there, and that's going to be very sensitive. Notice that we did not go above the high of that candle. Look how tight your stop loss can be. You can enter at the low and put your stop loss there. Very minimal risk. We get an accumulation. Anytime you see we're in bearish order flow and price is coming down and starts to accumulate, this down candle is going to be sensitive. Okay? So this is the mitigation block. We run up, we break through this. Now, I was discussing this with somebody on the Discord before. When price was coming back up, you may have gone short here. Put your stop loss there. You would have got stopped out. That's fine. You got stopped out. Wait for price to break below the mitigation block again. It breaks below it and then comes back up. If you get stopped out the second time, you are either offside or price is consolidating, which we see here. So don't get back in the trade. Just wait for more information. And of course, you were offside because it continued higher up. But once it broke below it, when it finished its work up here in this mitigation block, and we broke below it again, you just draw here. I'll just draw out this line over here. You delete these so you don't get confused. Broke below it again. We were ready for the real move. Look what happened. Price came back up, touched just the low of that, and dropped again. Look at that reaction. These mitigation blocks are extremely sensitive. Extremely sensitive. Nope, just a wick through, Luke. Just a wick through. Again, close below something mainly has to do with fair value gap. But just a wick is enough. So just like any order block is the same. That's why ICT said that in several different videos. An order block is an order block, whether it's a mitigation block, a breaker block. There's one video where he said order blocks have nothing to do with actual orders. He just named it an order block. Everybody thinks it has to do with orders, but it really has nothing to do with orders. The order block is the concept that ICT came up with to to draw your attention to a specific area in price because there's something going on behind the scenes there with smart money traders. So it really has nothing to do with orders. It has to do with the behavior of traders, of smart money traders at that area. So any type of order block, reason he named them what he did, mitigation, breakers, propulsion blocks, the reason he named them what he did is to try to convey the concept of what's taking place at them. But every order block is the same. As soon as price trades through the opening price of that, whether it's an up close candle or a down close candle, doesn't matter. It's the opening price that is the most sensitive. And as soon as price trades through the opening price of that candle, whether it's a wick or a close, there is a change in the state of delivery. And we can see that happening. Let me talk about this a little bit more, and then I'm just going to kind of wrap it up. I'll leave the other mitigation blocks for you guys to study on your own. And, of course, I've got all this information in the MMXM secrets. But I want to point this out because this happens with all PD arrays. When this was created, we saw this mitigation block get created. Let me make it a little wider. It was created, and then price traded through it right there. That made it sensitive. So then why did price go through it? This is what I was talking about earlier. When a PD array gets disrespected like that, everybody thinks, oh, you're wrong. You were wrong. This PD array doesn't work. That's not true. This PD array got traded through, and the algorithm marked this. The algorithm noted this and says, this is a change in the state of delivery. However, there is another PD array that I need to go and mitigate. This one. So traded through to this is giving you a clue that we are going to continue downward. But first, it needs to mitigate a higher PD array. This is how we get into a premium. This high to this low. This dealing range right here. Remember I said the true dealing range is the high of an area of accumulation. You reaccumulated here, that high down to the low. When we got up here, we barely went above the 50%, so it could have dropped there, but it had a higher objective. And it did that here. It went up to that higher objective and mitigated. Now that it completed its work up here, it can drop below, and it will, now that it's finished the work up here, it needs to come back and finish its work here. So it basically broke through here as kind of a marker. It put this on hold. until it could mitigate this one. Once it mitigated here, or the traders were able to mitigate here, and it took care of business there, then it sharply moved away. Now it's going to come back and mitigate here and then sharply move away. So there is a sequence in the way that this stuff happens. And that's what most traders don't understand. They mark out a fair value gap, and when price trades through it, they say, oh, these fair value gaps don't work. That's not true. They just don't understand what the algorithm is doing. It's got a higher objective that it's not finished with yet. Once it finishes that, then the lower PD arrays will become sensitive again, which we see here. That works with every PD array. So I think I'm going to end it there. All mitigation blocks function the same way. I'm going to end it there just because I've been talking a lot, and I don't want to bore you guys to death. Hopefully this is providing some value for you guys. And if you got any questions, please put it in the chat. I'm here for a little bit longer, so I'll try to answer some questions. That's right. The sensitivity is valid until the objective is reached. And that's what, that's another thing that most ICT traders don't understand. Order flow is going to stay the same until, let me go back to this example right here. This is a retracement. Notice that this retracement is going into the order block and into sell side. So order flow went from bullishness to bearishness, but it's going to stay bearish on the lower time frame. Let's go down to a 5-minute chart. Order flow was bullish and it shifted right here. It's now bearish, and it's going to continue to stay bearish until it hits this objective. Smart money reversal is what tells us that the objective is complete. Once it has taken sell side and hit another key area, then it's going to have a smart money reversal. That's why I mentioned earlier on the higher time frame, I said, how do we know where order flow begins, or where does order flow shift? It occurs at a true order block. Where do true order blocks happen? At the smart money reversal. Smart money reversals happen at the high or low of areas of accumulation or distribution, and at the smart money reversal of a higher time frame market maker model. So don't get faked out when price is running up. If we haven't hit our objectives yet, this running up is simply another entry for you. And when you understand this principle, you start to understand how you can pyramid into trades. Let me go back over here. If you see this happen, this smart money reversal leg, when price retraces here, you can enter your largest position here. You can go, this is what I like to do. You guys see me using 15 micros. I'll enter 15 micros right here. And as soon as we break below this low, I'm taking all 5 micros and I'll move my stop to break even. But if I see this second leg occur, when we get up here, I will add those 5 micros back on. So now I'm at 15 again. Then when we break this low, I'll take all 5 again. This is how you can either pyramid in, or you can scout. You can put on 15 contracts here and take all 15 contracts off at this low or at this low. Now let me tell you something about this right here. When we are at the high of an accumulation, when we start to drop, we know we're going to break this low, but how far is this drop going to go down? Here's the little secret. We are headed towards internal range liquidity. But let's say we take out this, let me pull this down just a little bit. Let's say this leg right here, oops, move that whole thing down. This leg right here is running to take out this liquidity. So we know we're going to take out this liquidity, but we're targeting this liquidity. This is the true internal range liquidity. This is not the internal range liquidity. This is a liquidity pool. This is not the one you're targeting. This is just where you can scale off. This is the one you're targeting. But how far below this are we going to go? And you go back and look. I've been showing you guys this, but go back and look at some charts. You're going to see this every time. How far below this liquidity are we going? It's only going to the highest up close candle right here. And when it takes this liquidity and hits that candle, you're going to see this retracement happen. If you don't see this happen, we are heavily bearish, and we're probably going to go down a lot further than you thought. But 9 times out of 10, when this leg happens, you're going to see us go only to this first up close candle, and then you're going to get a bounce. Same thing over here. You're going to see this go down to the up close candle over here, and then you're going to get a bounce. So go and test that out, and man, you're going to see some craziness. Anybody got any other questions? Please feel free to ask me any questions now or in the chat as we're trading next week. I'm trying to show how I'm using the mitigation block. Yes. Can I repeat once more where the highest probability order blocks occur? The highest probability order blocks are going to always be at the smart money reversal. So when you have a high, low, and higher high up here, and this break in market structure, this leg right here is going to be an order block because this is going to be a series of up close candles. That's going to be your highest probability order block. Same thing right here. This leg up is accumulation, but when you get up here, there's going to be an order block. We just saw that. Where were we at? I can't remember which one I was showing. I forgot where I was showing. I had a good example of that. But if you go examine this, every time you see in bearish price action, every time you see a retracement, look at the high. Go to a lower time frame and look at the high. You're going to see the same fractal that you see here, a turtle suit. You're going to see that here and here and here. You're also going to see it over here. You're going to see a turtle suit here, here, and here. If you don't see a turtle suit, if you see a failure swing, it's because of S&T divergence. If you see a failure swing on NASDAQ, go to the ES or the Dow and you'll see the turtle suit. So the highest probability order blocks occur at the smart money reversal. That's at the high of the higher time frame market maker model, and then every high of the accumulation areas and every low the highs of the distributions and the lows of the accumulations. That's where you're going to find your highest probability order blocks. Blocks over here. Now, once you get above 50% of this dealing range right here, once you get above 50%, this leg right here is not likely to come back to this mitigation block. It's normally going to happen in the discount range when you're bullish. Once you get above 75%, you're not likely to get back down to this mitigation block. You're likely to trade only into a fair value gap, and then because it's close to the liquidity objective. When you get close to the liquidity objective, it doesn't want to do stop runs. It wants to run and grab these stops. So you're not likely to get a stop run here or even a return into the mitigation block. So then you would turn your attention to this side of the curve. That's what a fair value gap, and that's what any kind of inefficiency, any kind of gap, whether it's the new week opening gap or the new day opening gap, the gaps, when we gap up, price is telling you it's ready to move in that direction. That's why there's a gap. It's telling you it's excited about moving to a direction. And the closer that you get to that liquidity, the faster that price is going to want to get there. That's why we get when you get a new day opening gap or a new week opening gap where price opens up and it never comes back to touch that gap, it just keeps moving up. The reason that happens is because we're close to the liquidity objective it's reaching for. So it's not going to go fill that gap. It's going to go get the liquidity first. You have to understand the algorithm it's only operating for two reasons: to offer liquidity to smart money traders and to rebalance the imbalances that it left while it was running to that liquidity. The primary objective is liquidity. The secondary objective is rebalancing. So if the primary objective is liquidity, as price moves towards that liquidity, if it gets close to it, it doesn't want to give those traders a chance to pull that liquidity out of the market. So it's going to hurry up and get there. That's when you get a big opening range gap or a new day or new week opening gap, and then it never fills. It just goes straight to liquidity. And then once it goes to liquidity, then you look for the smart money reversal to go back down. Well, where is it going to go down to? To fill that gap. The gap may have opened. It may have left the gap down here. And when price open, we get the gap start here, and it runs up to the liquidity with the buy side of the model. Once it grabs the liquidity, it forms a smart money reversal, and now we're going to go back down. Well, how far are we going? Is it just to clear this? No. We're going to go down to fill that open gap that we left because we were running to liquidity. How do we anticipate a model won't complete, like the one on gold earlier? Okay, let me go back to that. This is how you know that a model should not complete. If you started out your analysis on the day before, and this is what I did. I got caught in this because I did this very thing. This is an original consolidation. We got the points of accumulation in here, smart money reversal. and then we got the distribution happening. The reason this didn't complete, this is a market maker sell model. Market maker sell models are for bearish price action. Market maker models complete in bearish price action. But the problem is if you go to the higher time frame, we are bullish. This is bullish, a bullish price leg. So in bullish price action, market maker sell models will not complete. Market maker buy models will complete. Because remember, price goes down to go up. The reason why price goes down is for manipulation. They are trapping traders to go short. Traders that don't understand this principle of order flow, higher time frame order flow. So they're trapping people. So this retracement is going to trap traders, but it's going to hit a key level. And when it hits that key level, that is where all the orders of smart money are going to be accumulated to go long. And then we're going to complete the market maker buy model. So if you have, this is why you always have to start your analysis on the higher time frame. That's why I told you guys, go back and just look at any random video from ICT. I love to use the year 2022. I love to use the 2022 year because he was teaching the smart money reversal. 2022 model is the smart money reversal. He was drawing your attention to the fair value gap in the smart money reversal. But if you go back through those videos, look further to the left of the smart money of that fair value gap that he's drawing your attention to, look further to the left. You're either going to see a breaker or a mitigation block. So you can completely ignore the fair value gap if you know to look for the breaker or the mitigation block. But if you go back to 2022, almost all those videos, you can see a very clear and distinct market maker model. And when you do that, you will notice if you pay attention to the order flow, this is how you will always see that ICT always does his analysis from the top down. He always starts on the monthly, weekly, or daily chart. He does this in all his videos, but I just like to use 2022. But you can go to 2023. When he's doing market commentary, same thing. Go back to 2021, 2019. He's always explaining what he wants to see on the higher time frame, and then he goes down to the lower time frame. The reason why you don't catch it is because he doesn't always mark out the higher time frame levels. But that's why I posted that one video that I did where he actually marks out the higher time frame levels. And you can see the order blocks and fair value gaps forming right across the top of those levels like I showed you guys earlier. So just to recap that question, Luke, the way that you know a market maker model is not going to complete is determine the higher time frame order flow. And if it's bullish, market maker buy models should be completing. If it's bearish, market maker sell models should be completing. The one caveat to that is if we are going to do a stop run. If we are in bullish order flow, but we're going to do a stop run, then a market maker sell model will complete. Why is that going to happen? If it's a stop run, where are the stops at? In this section of price action, where are the stops? They're over here. Sell stops are right there. So if we're going to do a stop run before going higher, there are the sell stops. But if we're not going to do a stop run, if we're going to just continue higher, which is normal, and we're not going to complete this model, we're going to just go straight up. When you understand this order flow, that's why I said at the very beginning, understanding the higher time frame order flow is the backbone of everything else you're going to do. Because when you understand how to determine order flow on the higher time frame, you know which PD arrays. It doesn't matter which PD array you see the clearest, whether it's fair value gaps, breaker blocks, order blocks, candle wicks. The wicks, you can even use those. Doesn't matter which one you see the clearest. When you understand higher time frame order flow, then your entry model, whatever PD array you enter on, you now know how to determine if it's going to fail or not. I just told my wife the other day, I have never traded retail concepts. But if you taught me how to use a RSI indicator or a MACD indicator, if you taught me how that works, I could go and create a YouTube channel and I would have those guys thinking that I was just the greatest RSI indicator of all time. How would I do that? I know when the indicator is going to fail. How do I know when it's going to fail? Because of this principle right here, higher time frame order flow. I know when retail concepts are going to work and I know when they're not going to work because I understand higher time frame order flow. So hopefully this helped you guys. Of course, I posted all of this in document form in the market maker model. Smart money reversal is where we expect order flow to change. Now, we don't see a clear smart money reversal on here. It could be the wicks. It could be a smart money reversal. But always assume that if we are in one type of order flow or the other, whether bullish or bearish, just because you see a big down candle does not mean we are reversing order flow. You have to understand what caused that big down candle to happen. We hit a higher time frame PD array. That's why I said qualification of an order block, technically a smart money reversal, but the qualification of an order block, one of the main qualifications is that it has to hit a higher time frame key level. This is what will keep you from getting offside. If we are reversing, but we didn't hit a higher time frame key level, it's a fake out. Now, here's the problem with the monthly chart of NQ. We are at all-time highs right here. There is no price action over here for us to reference to know if we hit a key level. What do you do in this situation? I have a timestamp video for this in 2003. ICT specifically said, if you are at all-time highs, you must always assume that order flow is going to continue until you know beyond a shadow of a doubt you got a market structure break. So right now, on the monthly chart, we are still bullish. However, if you go down to the weekly chart, we are bearish. How do we determine that? How do we know we're bearish on the weekly chart? Down candles are being traded through. The low here, the low of this one was traded through, the low of this one, the low of this one. We had an inside week candle. And if you guys remember, I was saying I had a very loose bearish bias, but I wasn't sure what we were going to do because of where we were located. I'm going to explain that in a minute. But this is the reason that I had a loose bearish bias. This is the main reason right here. Because we were bearish on the weekly chart and we've been bearish on the daily chart. Now, here's the reason why I said we could have gone either way. I didn't know which way we were going to go. Market maker models always begin with a area of consolidation. What do you see right here? Consolidation. Okay, you can see this much more clearly on a 1 hour chart. Well, let me just do it on the 4 hour. See this consolidation much more clearly. So this could have very easily been the beginning of a market maker buy model. Why do I say it was a market maker buy model? Because of the direction price broke out from that consolidation. This is what ICT means when he says, when he's analyzing a chart and he says, I have to wait for more information. I don't know what we're going to do. The reason why I didn't know what we were going to do is because we had been bearish and we started consolidating. We could have broken out of this bearishly. This could have just been a pause and we could have continued bearish. But we didn't. We broke out bullishly. This is how market maker buy models start. We have a consolidation, price breaks out of it bullishly, and then retraces and then continues bullishly. I didn't know if this was just a stop run or if this was the beginning of a market maker buy model. If we had started a market maker buy model right here, what we would have been doing is beginning an area of accumulation. Because we are bearish, this would have been a larger accumulation. But now I am 100% sure we are resuming bearishness, and this was just a stop run. Why am I sure of that? Because we broke below the mean threshold of this consolidation. Something else that's interesting about this consolidation is where it was occurring. If you go on the daily chart, look over here. This is a market maker sell model. See that? Look at this. This is a inversion fair value gap right here. I have another timestamp video where ICT says that inversion fair value gaps form at the low points of market maker models. And he also said that when you see an accumulation inside of a fair value gap, that is the nature of a false bull or bear flag. That's why I was concerned about this. I didn't know what we were going to do, because not only were we accumulating and it could be a market maker buy model, but we were doing it inside of a inversion fair value gap. That led me to further believe this could be a market maker buy model, because retail traders are seeing a bear flag right here. And so this could have very well been a fake out to start an accumulation before dropping again. So that's why I wasn't sure. I had a conflicting analysis. I needed more information. But now that I have seen that we have gone through consequent encroachment of this consolidation, higher time frames are bearish. This is bearish order flow. This is bearish order flow. Now, of course, the monthly is bullish, or it's still bullish. But when you go down to the weekly, you can see failure swing here, and then bearish order flow. So what this makes me believe is that this bearish order flow is only going to last long enough to hit a key PD array on the monthly, which could very well be this order block right here, and then we could resume bullishness again. So right now, I'm bullish on the monthly, but the weekly and daily, I'm bearish. So next week, I am looking for bearish prices to begin with. Now, of course, at the beginning of the week, if I'm bearish on the entire week, which I am, I expect I expect this candle to continue next week, but I'm going to have to expect power of 3. Power of 3 means we're going to go up first into this candle and then continue bearishly. And that would be a weekly candle. So power of 3 on the week means Monday, Tuesday, or Wednesday, we're going to be bullish. And then somewhere we're going to get a smart money reversal, whether it be on Tuesday or Wednesday, and then we will resume bearishness. So for next week, I am bearish. This is the daily chart. I am bearish. So what I would be doing is looking for liquidity. I am bearish, but I expect to run buy side. Now, the reason I'm bearish, but I will need to wait until Monday to find the liquidity pools. Why is that? Because the opening sessions on Sunday and Monday, the Asian sessions and the London sessions, are going to engineer liquidity. And so I have to wait until Asia and London to see how the liquidity is formed. And then I can mark out my buy side and sell side liquidity. But right now, I am expecting to be bearish on the NASDAQ. Can you please go back to large time frame and where most probably we are headed to? Did that answer your question, Sosa? The higher time frame on the monthly. You guys really understand this concept of order flow, you need to go back to the videos I posted. It's month 6 of the core content. Month 6. There are 2 videos there. The first one is called what is it? Hold on, let me pull it up real quick. I'll just post it in the chat real quick. Let's see. Inner Circle Trader. Playlist. It's month 6. High probability setup, swing trade setups and bull market. Post this in the chat. What he is explaining here is how this is the reason I called this. This is exactly the reason that I call this the model that I created, the sequential time frames model, because you are working with time frames in a sequence. Higher time frame always is going to carry the other ones. And so when the lower time frames, the higher time frame, the intermediate time frame, and the lower time frame are all in sync with each other, and every time you see a discount PD array, you need to be buying it, because the lower time frame is immediately going to snap back in line with the higher time frame. But when you have a higher time frame being bullish and the next lower time frame to it, which would be the intermediate time frame, if that intermediate time frame is bearish, it is opposing the higher time frame. It can only do that for so long. How long? Until it hits a key PD array. And once it hits a discount PD array, it's going to snap back into line with that higher time frame. When you understand this principle of order flow, it will completely change your trading. Then when you get down on the lower time frames and start using that with mitigation blocks, it's just a whole another level, as you guys can see from what I've been posting. So hopefully that answered you guys' questions. Take this weekend and go and back test it. Go back test it and use ICT's videos for back testing. Just go watch his video. Ignore whatever he's talking about in that video and just pause the screen and use his charts. See if you can identify these concepts. And hopefully we'll all have some good trading next week. Cool beans, no problem. Glad I could share this with you guys.